Well, welcome to this installment of the Monaco Streaming Film Festival. I'm Andrew Wallenstein, the President and Chief Media Analyst of Variety Intelligence Platform, and I am joined by Naveen Sarma, the Senior Director at S&P Global Ratings. Naveen and I have made a habit in recent years of at least once a year having a conversation that takes stock of the media business from the broadest sense. And it's my pleasure to do this once again at what I think, Naveen, is an interesting time, because I think back to the first time I interviewed you back in 2019, and the discussion was pegged to looming fears of a recession, fears that I should point out proved unfounded then. Now, here we are more than 3 years later for a very similar conversation, though under very different circumstances. So how does where we stand now in terms of these recessionary fears differ from where things stood economically last we talked about this?
Sure. And as you point out, 2019, we talked about a recession. It didn't happen. We got a pandemic instead. So I went back and I looked through my notes on, what we thought was baked into a potential economic recession in 2019. And I've got to say that this time around, things are far more complicated. When we think of scenarios which could result in an economic downturn or a recession, there's multiple overhangs this time, any of which can ultimately push the economy into a recession. And I'm going to go through a list, and I'm probably going to miss a couple, but here it goes. High inflation. We haven't seen that in 40 years or 40 years, certainly since I've been working. But that's certainly a concern. We've got high interest rates. We haven't seen that since certainly before the Great Recession in 2008. We've got supply chain issues, which is impacting the ability to get product to consumers. We've got high energy costs in this country, but certainly in Europe, much more of an issue. We have labor constraints. The workforce hasn't come back after the pandemic, and so many businesses are so short of labor. That's resulting in high labor costs. And then we've got geopolitical risks. We have a war in Europe as well. And so all of those things are complicating the ability to assess what could drive an economic downturn, or what could result in an economic downturn, and then what could the impact be on companies.
Sounds like a perfect storm is brewing. And I have to wonder, what does this mean for the media business, which has its own particular issues that it's dealing with? But before we drill into that, let's talk about these macro pressures.
Sure. So go ahead. If you want to.
Well, I mean, what I'm wondering is, I guess to some degree, to me, whether there's a recession or not doesn't really matter. There's definitely an economic downturn that's happening, and I wonder what that's going to mean for the media business.
Sure. So first, let's define. We haven't seen any current evidence, or at least at the moment, of a recession. We had last quarter we had negative GDP growth, but you need 2 quarters for a recession. So recession technically is a construct created by economists and politicians. But ultimately, when we think about consumer spending and we think about the media sector, we're really thinking about how the consumers feel about spending, because consumer spending represents 2/3 of the U.S. GDP. If consumers feel stressed and stretch and they choose to cut back on spending, that ultimately will impact the media and entertainment sector, even if there isn't a recession. I think one of the things that we have to consider is consumers change behavior, sometimes permanently, due to stresses. We certainly saw that during the Great Recession, and we certainly saw that during the pandemic. In the case of the pandemic, we saw an acceleration in secular trends, which you and I have talked a lot about these trends. Whether it's cord cutting, it's the move to streaming, it's the shift of advertising from traditional media to digital. All of those things accelerated during the pandemic. If we get another economic downturn, we certainly think that could reaccelerate those trends again. And we can talk about what that means for Hollywood longer term.
Sure. I mean, I just think of all the things that could be at risk here. Advertising, right off the bat, to me, that seems to always go hand in hand with that. When there's some sort of economic downturn, that's the first thing that companies cut.
Correct. So advertising, actually, interestingly enough, is a lagging indicator of economic activity. It happens about 6 months. You start to see, advertising decline really 6 months into a recession. And so it's actually a lagging indicator, and then it tends to take some time to recover at post a recovery. Now, at the moment, we're not seeing any impact or any evidence of ad spending declines, though there is certainly expectations that it will decline if the current economic path continues.
Okay. And there's also, take your pick. Cord cutting is something that we got to keep an eye on. Theatrical attendance, which certainly has already been facing its challenges. And what to me is sort of the granddaddy of them all here is streaming, where could the timing possibly be worse given there's such a focus now on churn and retaining customers in a brutally competitive environment?
Yep. So let's tackle each one of those. So cord cutting, yes. Even prior to discussions of a recession, we at S&P expected cord cutting to reaccelerate. So it was about 4.5% if you include the virtual operators in 2021. We think it's going to reaccelerate to over 6% in 2022, and even worse than that in 2023. And then if you layer in, an economic recession, stressed consumers are more than likely to drop their linear TV services at a much faster rate. On the streaming side, churn definitely is an issue, and it's something that we've been spending a lot of time focusing on, because all of the streaming services have shown an ability to grow subscribers. What they haven't shown the ability to do at the moment is to retain those subscribers. And so your favorite show ends, you watch a movie, and then you cut the cord, you cut your streaming service, and then you come back after 6 months or so. And so what we've seen in a number of these streaming services is the subscriber base turns over once or twice a year. What happens when you go into a recession and consumers look at how much they're spending on the streaming services? They're spending a lot of money, and they decide they're going to cut back on the number of services, or they're not going to stick around as long as they previously did. And so that could reaccelerate churn, and that's got implications for operating metrics, cash flow metrics, and really the financial performances for the media companies.
Well, certainly there's other factors to talk about, and we'll get to theatrical in a second, but let's stick with streaming for a second. It's where all the eyeballs are right now in terms of the marketplace and what Netflix has gone through recently. Such a dramatic turn of events we saw coming out of last quarter. And so I wanted to get your take. Is it as bad as it looks right now for Netflix, or perhaps the market is perhaps reacting a little too strongly? What do you think?
Well, so there's the growth aspect, which is certainly a concern. I think a lot of the concerns that came out in the quarterly earnings were ones that the market had been focusing on and asking questions of Netflix. However, given the growth that they had previously, it wasn't a concern certainly for the equity markets, and that's password sharing, which as if you look at their results, they're essentially at, if you include password sharing, somewhere around 90 million households penetrated in the United States and Canada. That's basically a fully penetrated, mature market. And so, that the question that has been asked of them is, and this kind of addresses, this will impact a lot of the media companies in the next couple of years as well. As you start to get mature and as you start to see growth start to slow, what do you do as a result of that? Which would be the easiest thing, would you increase content spending, push more content in front of consumers? That'll energize subscriber growth going forward. However, there's a price to that. If you are going to be spending more money, you're going to push out your break-even points. You could go cash flow negative. In a way, that's a bit of undisciplined spending for the sake of growth. And as we saw with Netflix and its earnings, the market currently doesn't like that. And so undisciplined spending to just grow isn't the solution. You have to come up with other alternatives to try to re-energize growth, or certainly to try to reduce churn. And that's something that I think a lot of the companies are working on. And we'll see over the next couple of quarters, I think companies experimenting on ways to try to reduce churn.
And what do you think about the competitive set surrounding Netflix? It feels like once a week I see a survey of some kind addressing just how many services the average US home or global home needs. Is it 4? Is it 6? Is it whatever? What do you think?
So I mean, certainly the number of services that people are signing up for. I mean, I count how many I have. I think I have 8. That's unsustainable, especially if consumers are feeling stressed. They're going to cut back on the number of services. And is it 3? Is it 2? It's hard to tell. I mean, we're so early on in terms of the evolution of these services that I think the jury's still out on how many of these services people will sign up for. I think you're going to get a lot of experimentation over the next year or two in terms of business models. We're seeing Netflix say, they may introduce an advertising service. Disney's talked about doing an advertising service. That certainly, could benefit those companies because offering a lower price point might get them to stay longer with those services. You may see bundling be different. You may see, bundling of all of the services. So I think you're going to see a lot of experimentation over the next couple of years and trying to draw conclusions from what companies are experiencing today. I think in the next couple of months and years, we're going to have a different set of conversations about what that means for the streaming service.
What do you think about the hand Warner Brothers Discovery is playing with, especially as it relates to what you brought up with bundling? Because here they are with HBO Max, Discovery, rest in peace, CNN Plus. How does it all come together, do you think, for this company in the streaming space?
Yeah, look, I think one of the things that kind of got lost over the last couple of years, especially with Warner Media being embedded within the larger AT&T family, was how powerful a company Warner Media is, with its legacy of content going all the way back to the beginning of the film and TV industry. And so there's a lot of content there. And by the way, they have Warner Brothers, which is one of the premier studios in the world, and their ability to generate a lot of content. A lot of which they used to sell to third parties. Now a lot of that will go towards the HBO Max streaming service. So I wouldn't discount their ability to be one of the long-term survivors in the streaming wars.
Got it. I want to get back to what we raised earlier with regards to the state of the theatrical business. We're having this conversation the weekend that Top Gun returns to theaters, very high expectations there. I think even best case scenario for Top Gun, for the entire movie business, it's never that total box office, whether global or domestic, is just never going to get back what it used to be. In part because the pandemic, I think, will shrink the theatrical business, whether we're talking about just the footprint of the exhibition business or just more to the point, the kinds of movies that are viable in theaters, which, Marvel, a handful of horror movies, and that's about it as far as I see it. How do you see the prospects for theatrical?
Yeah, it's very interesting. Anecdotally, I've been to the theater 7 or 8 times since the pandemic ended, or I guess since the theaters reopened. I've yet to be in a theater that is crowded. I think one of the challenges at the moment is that there's significant parts of the population that are a bit uncomfortable going back into the theaters. Certainly, young adults and teenagers and 25-year-olds are comfortable going back, and so they're the ones who are flocking to the theaters to watch all those superhero movies. Children, on the other hand, parents are a bit uncomfortable taking them there, and so they've been slower to come back, as are older adults. The ones who would go and see comedies and dramas and things like that. I think those will relax as people get more comfortable with the idea that they're vaccinated and that they aren't going to get sick by going to movie theaters. But I do agree with your basic premise, which is I think longer term, the box office is going to struggle to come back to pre-COVID, pre-pandemic levels. The number of movies being released into theaters is has declined. It's unlikely to come back to the levels that we previously saw. Dramas and comedies, they work much better on a streaming service, or at least that's what the studios seem to think. And so putting them into theaters is going to be a bit of a challenge. I don't think we're going to go back to the days where you had day and date releases, or that studios would take higher profile movies and put them directly into their streaming services. I think the studios have learned a lesson over the last year or so that putting a movie through a theatrical release benefits the long-term long-term value of that particular film. You have better discovery, you have franchise building. All of those things are clear, and so yes, we've gone from 90 days to potentially 45 days for a release window. But I don't think that you are going to have the fear that everyone has, which is, or many people have, which is that the theatrical window completely disappears. Having said that, now we have an opportunity for a lot of companies, the Netflixes of the world, the Apples and the Amazons, to put more movies into the theaters. There's a lot of screens that are available, and they could take advantage of that. We'll see what happens.
What you were saying with regard to the pandemic overhang on the theatrical business, I'm wondering how you see other out-of-home media businesses faring, whether we're talking about theme parks, concerts, Broadway, all of which have taken some serious lumps in the past few years, but also have shown a lot of resilience. Longer term, how are you feeling about those out-of-home businesses?
Experiential is the word that all the media companies are now throwing around. So consumers don't just want to sit on their, in their chairs and have stuff happen in front of them. They want to get out there and experience it, whether it's concerts or going to theme parks or going to sporting events. I think that's where we think consumers are going to really push the media sector. We've kind of seen that already, right? The theme parks have done incredibly well. They may not necessarily back to 100% occupancy, but they are crowded, and people are signing up and going to those theme parks. Concerts, and especially the concert venues, are doing quite well, and we've seen a number of concerts get announced for next year. So next year, I think, will be a big year for concerts. But I do think people want to go out and actually interact with other people, and experience events rather than just sit at home.
Sure. Although, and I think to some degree that's being driven by the fact that people, because it was suppressed over the past few years, it's sort of exploding now. I do wonder, though, if the pandemic continues to persist, continues to linger, whether it's going to have a more deleterious effect than we might be envisioning here.
I don't know. I think at this point, I think the majority of the population has, in effect, moved on and told our politicians, yeah, we might get sick, but we think it's something that we can live with. So I don't see, and we're certainly not anticipating a resurgence of the pandemic leading to any kind of a shutdown in the economy.
Also wanted to ask you about M&A and deal making, which, going back to our recession conversation, I think is only going to get more difficult, which runs contrary to the narrative that's been prevailing the past few years that we're going to see more and more consolidation. How are you feeling about how the state of M&A is playing out?
Yeah, so at the moment, it's interesting. So for the last 10 years or so, actually since the Great Recession, interest rates have been incredibly low. The Fed cut interest rates, right at the beginning of the Great Recession, and they kept it very low, and they kept it low right through the pandemic to really stimulate economic growth. And that had some side effects or effects. It impacted it made money very cheap for deal making and M&A, and so we saw a lot of deal making over the last number of years, financed by cheap money. but what you're seeing today, however, is that the cost of capital, especially over the last couple of weeks, as the Fed has ratcheted up interest rates, the cost of capital has gone up considerably, and that definitely has hurt deal making in M&A. We've heard anecdotal stories of deals getting to the finish line, but dying because of expensive financing. Now, having said that, if we go into an economic downturn and the Fed decides that they do need to cut interest rates to try to once again stimulate economic growth, you certainly could see deal making M&A pick up. And look, that tends to happen towards the end of a recession. Companies have underperforming assets that they'd like to shed. You have companies that are underperforming because of an economic recession, that are unable to meet their financial commitments. You get bankruptcies, especially increasing after we come out of a recession. You get forced sales. So I think you could see a return to that, but a lot of that will depend on what happens to interest rates going forward.
And I'm thinking that what's going on in Washington will certainly come into bear here in terms of the potential for regulation. There seems to be an increasing focus on antitrust. Do you think that's going to weigh on the deal making as well?
I think it's a good point. I think it'll weigh on the desire of some companies to actually do deals. Clearly, the regulators in Washington and the politicians of Washington are very focused on the tech industry. And so we could see them step in and potentially, prevent or try to prevent deals happening that involve the tech companies. We saw some comments from the FTC about Amazon's acquisition of MGM, and in the grand scheme of things, MGM is tiny compared to Amazon, and yet that raised a number of concerns in Washington over that deal. So it kind of depends on who's getting involved in those transactions. I think with media companies, if you saw further consolidation in certain sectors, if there's a consolidation of movie studios, that might raise some regulatory issues. Certainly, if cable companies decide that they're going to try to merge, that could raise some issues. But I do think especially the people who have the money today, it's the tech companies. They may be limited in what they can do given the heightened focus on their businesses.
Staying on tech for a second, it's an interesting time because we've looked at these businesses as too big to fail for so long. But here we are coming off a week where, we saw Evan Spiegel at Snap revise guidance, which sent the stocks for anyone in digital advertising plummeting. We're seeing Meta take a huge hit coming out of their previous quarter. Are we finally, kind of as we saw with Netflix, are we finally seeing companies that seem too big to fail, too successful to stumble? Are we perhaps moving into a new era of understanding just how incredible these companies are?
It's a possibility. I think what's interesting is the discussion. I was at a conference for the last couple of days. In fact, I was at the conference where Snap spoke. And the question that everyone was asking was, is this a Snap platform issue? Are they just losing share to platforms like TikTok? Or is this the forerunner of an advertising decline or pressure on advertising? So when you look at digital advertising on tech and social media platforms, they may be more vulnerable in an economic downturn because so much of that advertising is skewed towards small and mid-sized businesses. And they certainly get hurt in a recession. In addition, when you think about the ad funnel, advertisers allocate bottom of the funnel transactional ad dollars to digital platforms. And these may be more vulnerable. These dollars may be more vulnerable if consumers cut back on spending. And when you look at top of the funnel brand advertising, that might see less decline depending on the recession scenario, which may actually benefit television. So what we're seeing with the tech companies might be specific to Snap, or it might be a forerunner of pressure on digital advertising in a recession.
You're mentioning spending. made me think of a different area of spending that I'm curious about, which is content spend, which, has risen astronomically in recent years, primarily because of the competitive streaming marketplace. And I have to wonder, certainly as we've seen, Disney recently announcing that they're going to shave $1 billion off an initial spending projection they gave earlier in the year. We've seen David Zaslav at Warner Discovery more than once say, hey, we're not going to get crazy here. Are we on the verge of a broader based pullback in content spend? And what would that mean?
Yeah, that's the $100 billion question. That's
more than $100 billion.
Yeah, exactly. Look, I think at the moment in Hollywood, the message that we're hearing, as you point out, is that all of the companies are going to be disciplined in spending to grow subscribers. It's not that they're going to cut back on spending; it's that they're going to control the growth of spending to be more disciplined and look for and grow what they would call financially responsible subscribers. So I don't think the fears of them cutting spending are accurate. I think what we should be asking the media companies is how much are they going to increase spending this year to next year, and then the following year, and then the following year. I think that is where we're going to see the discipline. And look, at the end of the day, what that results in is that they get to financial stability, break even on their services faster. And then that's what the current, equity markets are rewarding them for. I think one of the concerns that we've raised as a result of that is, okay, so let's say we get to the end of this year and subscriber growth is weaker than the companies had anticipated. Churn might be higher because of the economic recession. What do the media companies do? Do they back off this pledge to be disciplined in their spending and spend a lot more to try to re-energize growth? Or do they, like what Netflix has done, which is, look at their spending and say that the growth of spending will go in line with the revenue growth, and so be more and continue to remain disciplined in how they spend on content?
I can't imagine that we're going to see an increased, ratcheting up of spending. And if anything, what we may see that will bring down spending is, with regard to the streaming business, somebody's going to step away from the table. Somebody is going to say, this is getting too rich for my blood. Doesn't necessarily mean I think there's a few scenarios there. Number one, we could see someone pull out and revert to the Sony model of, hey, we're an arms supplier. Everyone could buy our content. Or we're going to see perhaps a consolidation among players. And there's been plenty of speculation about Paramount and maybe a spun-off NBC Universal. As I mentioned, those companies, I'm particularly curious about Paramount and what you think about the hand that they're playing. What would you be advising Sherry Redstone in this marketplace?
Yeah, it's a good question. And I think one of the things that we do forget when we look at the U.S. media companies and we size up Paramount versus Disney and Warner and Warner Brothers Discovery, Disney and Warner Brothers are massive companies. They're massive global companies, far bigger than everybody else. Paramount is actually a global media company as well, and they've got tremendous scale. And so I think one of the things we forget about is what is our comparison to? If we're just looking at U.S. companies, yes, Paramount has a scale problem. If you look at Paramount versus the global media companies, and you throw in ITV, you throw in Bertelsmann and Vivendi, Paramount is a very, very large, diversified media company with operations all over the world. They've got a big Latin American operation. And so I wouldn't discount their ability to be one of the winners. Having said that, they certainly have more limited financial resources than a Disney or a Discovery. And so they have to be a bit more careful in what they do, especially internationally, what content they greenlit, and also what markets they operate in. So the approach that they've taken so far, which is they'll settle or license some of their content, and then in markets where they don't think they can get a good return, they'll partner like what they are doing with NBC in Europe. I think that's a good financial model. I think that works as long as you remain disciplined, again, once in your spending, and also in your expectations for what growth it will be overseas.
I think Comcast is a bit similar in terms of that international scale through Sky. Comcast, though, is a very different company because they're in the pipes business. And I'm curious what you think about that business. We talked a little about cord cutting, but it's more than that when you think about how Comcast is really almost more a broadband company now, and they're in mobile. So how do you feel about the broadband business and where Comcast stands there?
Yeah, and I'll say this about Comcast as well as for companies like Amazon and Apple. They've got businesses that are far stronger than the media businesses that they own. And those are the businesses that they want to defend. And so maybe not as much for Comcast, because NBC is as you point out, a global media company. But media in essence can be a retention tool for some of these companies. You offer the media you offer media, video, film, TV to your subscribers, whether it's an Amazon or it's an Apple, and you essentially give it to them for free and say, if you sign up for our services, you can get this as an add-on. And so you can use media as a retention tool. We can talk a bit about what that means for media in general. Comcast has a similar type of strategy, maybe not necessarily as draconian as what I just laid out, but they are more than willing to use media, and they do this within their Comcast broadband footprint. They offer Peacock for free to consumers, and that's an attempt to keep customers on their platform.
Well, let's talk about that media as retention tool strategy more broadly, because it's interesting when you look at Amazon and Apple, media is really just a rounding error, even though they are going to be spending huge amounts of money compared to everything going on in media. So in this weird counterintuitive way, is it almost like, well, the best way to approach the media business is not really to be focused on it, which sounds insane.
And it is, because especially if you're a media company and you've got returns that you're trying to achieve on content, and some of your competitors don't really care about the returns because they're looking at their subscriber numbers, it's a hard thing to compete against. How much are you willing to pay? There may be discipline on the side of the traditional media companies in terms of what they're willing to pay for a certain piece of content, but that kind of goes out the window when you're looking at some of these other companies. And so it makes it an unbalanced playing field for the traditional media companies.
Yeah, but it is a playing field that I'm enjoying watching immensely, and I know you are too. Naveen, appreciate you sharing your insights today. Always good to talk to you.
Great talking to you too as well. Thank you.